My first venture in 2018, I launched as a company called Whirli. What we did was quite unique at the time. It was a sharing economy for children's toys, parenting goods, and other playthings. The problem statement quite simple. Parents spend a lot of money on stuff that they don't need for a very long period of time. And so we thought parents should be renting or borrowing these products rather than buying them only to see them go to waste just a few weeks, a few months later. I started that as the sole founder CEO in 2018. Over 4 years, we grew it to a 3 million plus ARR business. We had 65 employees, including our distribution center as well. We owned over £1 million worth of stock and assets on our books that were circulating through the sharing economy, filled with about 10 to 15,000 parents across the UK. The fundamentals of the business was really strong, but unfortunately, our Series A got undone during the Ukraine war when it started, and I'm sure we go into detail there. Took away a lot of learnings despite what was a disappointing outcome for myself and the team. And then spent 2 years at a Series C fintech called Primary Bit, based in London. They do capital raising, technology, IPO, secondary shares, so a very different sector. I was the chief operating officer there. I then spent this time thinking about whether, do I even want to be a second-time founder? That's a big question I think repeat founders always ask themselves. And then when I decided that I wanted to do it, what was the thing that I wanted to work on? It was at this time period that I became a homeowner in the UK. And if you are a homeowner, given through rent, if you are a landlord, you know that UK building stock is poor and management is a real pain. It's costly, it's time consuming. And then that clued me on to what eventually crystallized to my current venture, a company called Hey Alfie. We're still semi-stealthy, but we're in beta mode right now, where we're building AI agents to help people manage their homes and manage properties in a nutshell. Left Primary Bit at the start of this year to do that. We raised our pre-seed in February, March. Raised quite a chunky pre-seed at about £2.7 million. So we're very happy with that. And we launched our beta just a few months ago, which is going quite well. So we're looking to maybe do our seed fundraise in the next 3 to 6 months already. But yeah, that's about me.
And you now have baby Ethan.
Yes, and I became a dad as well. Yeah. So thank you. So there's a lot going on.
There's a lot going on. But I think just to know, so when you and I first started getting to know each other and Whirli was sort of at its height, we have young kids, everyone in our NCT groups was on Whirli. Yeah. Like it was like the done thing. You didn't convert my wife and that desperately needed doing. We have more toys than we know what to do with. But so today, let's dive into really Whirli and the learnings from it and how you're doing things differently now at Hey Alfie. Yep. I think we'll talk for sort of half an hour, 45 minutes, and then really happy to open it to the floor to take it wherever you want to, whether it's to dive into things that we've spoken about in more detail or actually you have your own questions. And we always encourage people, be selfish with it, talk about your own businesses and get into the detail. So I guess just to take us to the beginning of Whirli, you have this idea. How did you test it? What were the metrics that let you know actually this might be something and we may be able to scale it?
Yeah, my founding story for Whirli was quite unique because if you put the 2 and 2 together, I only just became a dad 2 months ago. So when I started Whirli, it was not a founding story, which is common in the industry of, I've been a parent for like 10 years and these are all the problems being a parent and this is why I created this business. I started Whirli because a lot of my friends were having kids, and every time I went to visit their houses, I was like, guys, what the hell's going on here? There's so much clutter, there's so much mess. It's just so much. They're all talking and complaining about this problem. And then I started clearing onto, okay, there must be a good solution here. And so it was quite interesting being a founder that was building a product that I personally didn't use. In fact, maybe that's something that I'll talk about. There was both a benefit to it and also obviously a bit of a downside to it. But when I started researching and looking into this problem, it just ticked all the right boxes for me. I think founders need to have a little bit of a philosophy of like what kind of founder you want to be as well. So when I started this journey as I was leaving management consulting, I was thinking to myself, like, look, I honestly want to work in something where I would feel quite proud of the service that I've built as well. Yes, I think we're all in it to have a good level of achievement. Most people are also in it to have a good level of financial reward. But I also wanted something that I thought I could be proud of. And back in 2018, ESG was all the rage. When you look into some of the numbers and the stats, as I started doing some desk research, it was kind of crazy. Like, we did a little survey that showed that Christmas is just around the corner and kids all across the country, across the world are going to get a bunch of toys. About 35-40% of these toys that are given at Christmas are unloved by January, so just a month later. And so we did all the maths that extrapolated that to like the scale of the problem we're talking about in the UK alone is nearly 1 million toys that just go unloved like in a month, right? And so that got me.
I could have told you that.
Yeah,
Research on my house.
It's true. That's one of the things that I've learned as well. Like, because in the early stages of Whirli, I was coming off a corporate life where we did a lot of like this kind of desk research. Where you raised a really good point. Like, actually, you could just speak and you do things faster in a way. When I started Whirli, one of the things that we did to really validate the idea. I think it's classic common wisdom and advice. We kind of launched not even a prototype service, we just launched a landing page to see whether we could advertise and get people interested and whether there's traction. Whirli is a consumer business, so it's a lot easier to test hypotheses and test things in consumer environments. But one of the things that we did was that, look, let's just create a simple 5-page website. They just explained what the service was going to be in some way, shape, or form that we thought it was going to be, roughly what we thought the price point was. And all the CTA was like, if you're interested, leave us your contact details to join the waiting list, right? And then we launched our Facebook ads. And the reason why I thought this was really important is that quite early on, I clued onto the fact that all your friends, all your colleagues, all the people that you know will always be super polite about your business. And like doing a survey monkey to my friends who are parents was not going to tell me or validate that much for me. What I really wanted to see, which we saw, and that's why we then spent the money to build the actual service, was that when we launched Facebook ads going out to parents, strangers that have never interacted, all they saw suddenly was this ad about and a 5-page kind of like website were sharing it. They were saying this is such a cool idea. They were tagging their friends, they were tagging their spouses. They say, hey, we should sign up to this when it kind of launched. And that was a very quick and easy way to validate that, hey, there's something in here. There's not just family and friends telling us. This is actually reflective of the true go-to-market that we would actually kind of deploy when the service launched. And that was what gave us the kind of like the validation to then launch the service. Like 3 or 4 months later, we had to. It's a physical goods kind of company, right? So we had to get a warehouse, we had to get stock, we had to get suppliers. So a huge kind of operation. And then we started testing things from there. And once you're live, then the testing gets again easier as well. So we did a lot of tests early on, but we always asked ourselves like, what's the cheapest and fastest way for us to validate a hypothesis? And also being unashamed to kind of do stuff without having the full service behind it in a way.
Because I'm thinking for people in this room, obviously already scaling businesses. Yep. So should that be the same with all new products, arms of the business, whatever it may be?
Yeah, so we've taken this learning into my current business, even at Healthy. And so we are about 3 months from our beta start. We're already doing something like 100K of annualized revenue, so we're quite happy with that. But it's a transactional business. It's a marketplace business where we get commission off kind of basically people finding tradespeople, plumbers, roofers, and all that kind of stuff. So we wanted to do something similar where, hey, can we test whether there's a subscription angle here? And so in 2 weeks, all we've done is that we've built kind of like, again, it's a page on our app that just says, this is what Healthy Club is. It's a subscription service. And we have none of the tech to actually manage how the subscription works. So if people subscribe, we're manually kind of like checking to see if they have a subscription and everything else. But we launched that super quickly again to just like test like, okay, this is a new product we want to bring to market or a new kind of model for it. How does that work? And just moving very quickly. I think some of the best startups that I observe all do that constantly, all the time. They're unafraid of like selling something that doesn't exist yet, as long as you have the full confidence that if someone actually buys it, you can deliver, right? At Healthy, we also have a B2B angle. So it's a complex business, a B2C marketplace and a B2B angle. So one of the things that we've done is that we've actually secured an LOI / kind of like intent from a first customer before we started the B2B product. All we've done is Figma prototypes, gone out to the market, sold the B2B product using Figma prototypes, with the caveat that if you're interested in this, it will take us about 3 to 6 months to actually deploy into your portfolio. And we've got our first customer that way. And this means that when we invest the money to build the B2B product, we know that there's traction. All of this, I think, kind of boils down to the notion. I think as founders, you're always limited by resource and time. And so it's always about what can you do to give yourself the intel to know that you're investing your resource and time wisely, that you're not going to make a bet that turns out with nothing. So we try to make sure that we de-risk our bets. Like now we've built the B2B, we know we at least have one customer off the back end of it. Same with the kind of Healthy Club. We're going to get our first kind of 10 or 100 subscribers before we actually automate how the subscription actually works.
Makes sense. How do you know if you've got that right though? People don't sign up, say. How do you know it's not the product, but it's the price, or it's the way you've worded it, or how do you actually narrow that down?
Yeah, so I'm quite analytical as a person. So my team, we build an analytical team around us. We do a lot of tracking. So that's one of the things that we always try to get very sharp on in terms of like where are the conversion drop-offs, what's happening. At the end of the day, nothing beats speaking to customers or speaking to potential customers for feedback. And so like day to day, it will always kind of launch a new thing and see like, look, if that's not biting, where's the drop off? Is it people just not clicking on the ads, then the ad copy is poor. If people are clicking on ads but not going from landing page to the conversion flow, then the landing page is poor. And it's all about iterating, right? Because the best thing you can do to validate is that when you see something is wrong, you try something, and if data changes, if the kind of like results get better, you know that you've kind of impacted it that way. If nothing changes, you know there's something deeper, a more fundamental issue. I think the main kind of mistake that I see founders take in this kind of like iterative kind of way of working is sometimes the iterations are not bold enough. So even with my team, right? My team will occasionally be like, oh, we've launched a new ad campaign. The CTR is only like 2%. Our best performing campaigns have a 6-7% kind of CTR. I'm going to tweak something here and there. And for me, tweaking stuff leads to a marginal improvement. It doesn't lead to that big of a gap. And so sometimes I think some of the things that consume founders and consume startups is that when you're quite far off where you want to be, making too little incremental tweaks when what you need is something bolder and bigger. Because this iterative kind of like methodology just takes time. If you run the test for 2 weeks, then see results, it takes you 2 weeks to learn something new. If you need to iterate 5 times, that's like 10 weeks that you need to take to figure out whether something's going to work, and that's too long of a period of time. So occasionally, the main thing I do encourage in my own teams as well is like, take a bit more risk, be a bit bolder with some of the tweaks you're making kind of week in, week out, because otherwise anything too incremental will just take you too long to get to your end result.
Makes sense. One of the things we've done recently is actually go out to our network and ask them what the big challenges are for them over the next 12 months. And one thing that's come up repeatedly is on the marketing side, branding, getting the name out there, particularly doing it on a limited budget. So once you've validated, let's go back to Whirli. Once you validated Whirli, how did you then get that out there? You mentioned what is now Meta, but how did you do that on a budget?
Yeah, so I think when it comes to brand recognition, I always think about classically the breadth and depth of brand recognition you want. And what I see, I don't know whether it's mistakes, but different approaches some other people take, is that they focus too much on breadth. And in the limited budget, it's hard to get both breadth and depth because of just what you're restrained by. So at Whirli, we focus a lot of how do we get really good depth in our target demographic. Our target demographic was very specifically parents that had newborns, largely 0 to 2 years old. And when you focus your budget on that, it's much easier to make a brand really well known in these kind of like smaller demographics than get your brand kind of out there. So we avoided doing things like, actually we tried that and then they completely failed and it's a complete waste of money, but we tried some influencing campaigns early on, but they were very broad influencers. They didn't have like really good demographics. We then over time started moving into long form video content because what we clued on to was things like, and I know this now because my wife, having a 2-month-old, she spends all her time just watching vlogs and whatnot, right? But this long-form content is a lot more engaging. There's a lot more depth. There's less breadth for sure, but there's a lot more depth, right? Because someone's watching content for 15 minutes, and this 15 minutes, an influencer talking about a service, unboxing stuff, talking about different toys, etc. And so my advice usually is like, first of all, fight the temptation for vanity metrics. And so the reason why a lot of founders choose breadth is because they like the vanity metrics. And to be honest with you, we suffer a little bit from that. If I went to a VC who was not a parent, they'd never heard of us. If I went to a VC that was a parent, they were in our kind of target number and they knew about us. They watched some of the things. Their wife, they kind of like know it's better. But we focus a lot on the fundamentals of a business, and so we push very hard on depth in a very target kind of sector. Within depth, I always talk about repeats as well. You want kind of like, classic consumer thinking is that someone needs to see your brand about 6 or 7 times before they really remember it and understand it. One thing that hurt us a little bit as well was that we were quite a unique company in the way our service worked. And so you really needed that 6 or 7 kind of interactions with our business to actually understood how the subscription works. It wasn't something that they could see one time as well. And then we focus on word of mouth referral. I think nothing gets brand across better than word of mouth. It's one reason why VC investors all like seeing organic growth and all like seeing that as a huge focus. The NCT groups were very big for us. So something we, again, kind of clued on was that parenting is often done in community-based things. People go through as a life stage together. NCT groups were a very popular way for people sharing tips and tricks. So we started giving lots of affiliate programs, referrals for parents who do that. I think we had even one super user that referred like 40 customers to us or something insane like that. And that was because she was a facilitator for NCT groups. And I'm by myself. They're not meant to do that, but whatever. But then it was great. We started printing material. So we started telling anyone, any subscriber, like, look, if you run an NCT group, if you just run play dates with friends, if you throw a birthday party and you're a subscriber, You can ask us for flyers with your discount code printed on them for you to give out as part of the gift bag and stuff like that. And that's the kind of stuff that, got a lot of brand recognition in that space, because we were hoping that our subscribers, when they hosted a birthday party with 15 other kids, they would be telling all the parents about Whirli. They put their own flyer in there, and then the parents went left with signing up. And I think brand is the other thing where there's a bit of hive mind on it. If like all your friends like a brand, you will just like it as well. It's just kind of consumer psychology. And so we tried to build this thing, which I think worked quite well, where every parent loved the service. And so you couldn't be that parent that didn't sign up, or you couldn't be that parent that didn't know about it, didn't kind of investigate it. And we pushed the angle quite hard as well.
How do you look at, so the breadth and depth thing, I'm keen to push on that. Does that vary depending who the audience is? So are you thinking about that differently for Hey Alfie?
No, so I think like in general, I think most business strategy works best when you have a very clear target ICP, ideal customer profile, a very clear target customer persona that you're going to make the early stages work for. I think it's not easy to create a business that works for the masses off the start. And so most companies focus on the target persona. So say for Hey Alfie as well, our target persona, quite analogous to Whirli actually, we like homeowners that just moved into a home in the last 2 or 3 years. Because if you just moved into a home, again, that's when the pain point is the greatest. There's some adjacencies or demographic impact as well. If you just moved into a home, you're usually in full-time employment, you're usually of higher household income, you're usually slightly younger in demographic, so you're about 30 to 40, which is a good kind of like target demographic for us. And that's the area that we're trying to build kind of brand perception in. So in a very similar strategy that we've kind of lifted from Whirli almost, we're starting to create an affiliate program around all the different parties that are involved in a home transaction or home move. What we want is that in 3 years' time, when someone's moving to a home, the estate agent recommends Hey Alfie, the solicitor conveyancer recommends Hey Alfie, heck, even the moving company that's moving boxes into your new home say, hey, you've moved to a new home, have you heard about this thing called Hey Alfie to help you manage your new home? And the reason why they'll do that is because we're trying to give them commission on basically all of these kind of referrals. But no, I think I personally think it's easier and usually more economically viable to prove it out in a narrow kind of like customer segment and then prove the depth of the brand recognition there. I suppose at the end of the day, the question you have to ask yourself as founders, like, would you rather 1,000 people have heard about and know about your company, but within that only like 10 to 20 are target customers, or would you rather like 50 target customers be really deep and know about your company really well? So that's how I think about the brand question. And my personal philosophy is deep on the customer target because it helps you prove the economics and helps you prove the kind of stuff that you need to show to investors for the fundraising.
And I guess part of that comes down to which channels you use. So again, when a lot of the founders probably here are looking through which channels they should be focused on and which will become truly scalable for them, how did you figure that out? And which were they in the end?
Yeah, so I think no major surprises here. In terms of paid marketing, for consumer-based businesses, search on Google and social on Meta still dominate, and they still have some of the best algorithms. I personally hate paid social. Paid social is really expensive in a nutshell. One of the challenges I had at Whirli was that because it was a new service, there's absolutely like zero search volume. No one was searching for toy sharing economy. No one was searching for toy subscription service either. So there was no high intent search volume we could plug into. And so our main route had to be community-based kind of social platforms where we knew parents were very active on, predominantly the Meta platforms, Instagram and Facebook. And then also, as we expanded, there was a little bit of Pinterest because people, decluttering was a huge theme. So Pinterest became quite big. And then as the younger folks in the team told me, TikTok was getting big. And so then we started TikTok, and TikTok performed even better because there was less competition on TikTok than for parents especially, than say Meta and whatnot. So at Whirli, we suffered from not having enough search volume to make paid search work. We even suffered for therefore organic search didn't really work for us. Consequently, our CACs were higher, I think relatively high compared to what benchmarks say. We were doing CACs like £50 or something like that. But the retention was very, very strong. And so we were solidly helped by the fact that monthly churn was less than like 4%. Lifetime value, customer lifetime was predicted at 3 to 5 years. And that helped us offset what was quite a high CAC in a nutshell. At Hey Alfie, we actually have found the benefit of Google search is like most people search for tradespeople or search for home improvements things using a web search. And so we lean heavily on kind of search as the main area to kind of onboard. But the problem with search platforms is that there's not a lot of creative, there's not a lot of ad copy, it's quite transactional. So it doesn't help build kind of brand and repeats. One of the things that I hear from a lot of peers in my sector is that you get high intent search, someone comes on a platform, they find a plumber, maybe say, but 3 months later they need an electrician. They don't remember which platform they were on because it's that transactional. Whereas, for example, on the social platforms, like a customer, again, they used to see a Whirli ad 5 or 6 times before they signed up, and we didn't kind of mind that because it got the brand stuck in their mind versus a transactional kind of search path. And so I think, like, look, for the consumer businesses anyway, like, it will be important to make sure both paid marketing in the classic channels on paid search, paid social as the early channels works. As you scale, what we found was that actually broader display video, YouTube worked quite well. We actually experimented on TV for a little bit. And one of our proudest moments was when Holly Willoughby said that the service was fantastic on ITV Good Morning. So we were very happy with that.
Amazing.
When that was going on live, we had Google Web Analytics live and traffic spiked like a few hundred or something like that just on that second. But those are things that you can only really do when you have big enough budget, when you have big enough scale. AI searching is getting more popular. You guys might read about it. Probably be important to plug into that, depending again on where your target demographic is. And I say that's probably the most important thing. Figure out where your target demographic spends their time. If a target demographic spends their time a lot on AI search engines is the place for you to be. If they spend a lot of time Meta's the place to be.
How do you, I've been thinking about the AI search engines, and that's the way that people are searching at ChatGPT. How do you augment that for your own business? How are you augmenting that?
Yeah, I'm going to be honest with you. We haven't kind of dived very deep into AI search as of yet. I think it's taking off more in the US, where there are quite a number of good US startups that are plugging in to help people advertise on ChatGPT and others. We haven't started it yet just because our marketing budgets these days are tiny. I only spend like £500, £1,000 a week on marketing. And again, I think it's one of those things where picking the channels you're deploying your budget is quite important, because when you have a small team, you don't have the overhead capacity to manage 5 different channels. You kind of make 2 or 3 key channels work out and have one person manage 2 or 3 key channels. So we haven't actually cracked the kind of AI search engine kind of problem as of yet. Part of me is hopeful that for Healthy at least, because we are looking for homeowners who want AI to manage their homes, we'll find kind of good results there. Part of me also worries that, frankly, ChatGPT itself is a competitor to our business in a way. And so are we going to find better joy, get you people who are super AI native already, wanting to switch to a different AI platform? Or are we going to find better productivity in people who don't really use ChatGPT for home management, finding out that there's a purpose-built kind of like vertical AI platform for it? It's a hypothesis that we want to validate, and we're not sure where we stand on that yet. Some of the early traction we're seeing from Healthy is surprising as well. We do better at older demographics. So as I say, our target customer group is like 30 to 40. But we see like 60-year-olds having like 40 message long conversations with our AI tool. They actually really like it. And we see CTRs better at the older demographics as well. So a few counterintuitive learnings there about AI adoption plus the route to market and what that means for the target demographic you build.
Amazing. Well, look, I'm keen to dive into, and look, we can go more into the marketing side as well in the wider Q&A, but keen to dive into fundraising as well. And out of curiosity, how many people are raising here currently? Just so we know how relevant this is. Okay, probably about half of you.
Always be raising. So
Always be raising.
That's one thing I've learned. Always be raising.
So for Whirli, you raised 4 million seed, is that
we did
right?
an angel round that was $1 million or so, largely a bunch of management consulting partners, family, friends, and whatnot. And then we did our seed. It was a late seed at £4 million, some slightly over 4.2, something like that. My fundraising story at Whirli was painful, frankly. I used to join, maybe even made this joke to you after of it. Every time I tried to fundraise, a global catastrophe happened, basically. So the first time every time I fundraised, like a global catastrophe happened. And at some point in time, I was like, I'm just going to promise the world I'm going to stop fundraising, just to give you guys a bit of a break. But the first time I came out to fundraise my seed, we were, 6 months in. We just finished our pilot. We had decent ARR, decent subscriber counts.
What was your
but
ARR?
It was 300K, something like that, a few 100K. And it was March 2020. So everything was going quite reasonably well. People liked the numbers, they liked the service. ESG was super hot. We were very unique as a company. I still remember going to VC meetings and we were all joking about this thing in China. We were all sterilizing our hands. They just introduced sterilizers, but people were still in the office. And then lockdown happened. And basically all the VCs were, they said on LinkedIn that they're all open for business, but not really. They're all firefighting the portfolio. No one was taking meetings. People that were talking about term sheets coming the next week or two stopped replying to me for like a month or two. We were put in a very difficult position as well because we're an e-commerce business and schools were closed. And so parents were looking for a lot of ways to entertain their kids and cost-effective ways to entertain their kids as well. So apart from Amazon, we're one of the big online e-commerce places. You get a bunch of educational toys for your children. And so business was surging in that time. And then I had warehouse absences, like 40%. All our delivery drivers are constantly sick on, isolated, not able to do pickups. It was a chaotic time and probably one of the busiest, most stressful times in my career. I think I worked every single day for like 6 months or something like that, right? And then the market calmed down. And later that year, just before Christmas, I came out at September again to do the seed. It's like 6 months after lockdown, after it started and things were getting back to normal. And then we finalized the seed round with Octopus Ventures, MMC, Blue Wire Capital, so 3 VC funds in December that year. I raised £4 million, so we're very happy with that. The second time I then came out to do institutional fundraising, because of the nature of our business, we like to do a strong Christmas. So the plan is always trade a really strong Christmas and then come out and fundraise right after that. So we did a phenomenal Christmas in December 2021. And December 2021, that Christmas, we grew our subscriber base like 30-40% just in the Christmas season alone. Got to about £2.5 million of ARR. So we're really quite happy with the performance there. And then we fundraised and everything was going really well. And then the war in Europe started. And again, everything kind of like completely went to bits. And this time...
Just out of interest, how do people actually link a war to kids using toys?
And so...
Is it production?
No. So what you'll find is that the venture capital ecosystem is hugely driven on narrative and macroeconomic themes generally.
I understand that, I've read money, but I just think that's bullshit.
Yeah.
Because ultimately, toys and kids are being born every day. This war is completely separate.
I made the argument many times myself, but yes, and the challenge you have is that investor, especially in VCs, is very conviction, confidence driven. And so when confidence in the market disappears, it's why the VC market was in a down market for all of 2022 and all of 2023, and 2024 even took a while to recover. A lot of it is tied to sentiment in what the stock market is doing, because if valuations at the exits go down, then everyone loses conviction.
That was a lot to do with the whole balloon of
correct.
subscription-based businesses that blew up.
It's a self-fulfilling prophecy in a way, right? Like what happened is that 2021, the stock market went absolutely bananas, and people were then tossing money in, and same thing's happening now to a bit of extent in the AI space, which I was just musing in our VC. I think we were all around in 2021, so I don't know why we're making the same mistakes this year, right? It's literally the same VCs and the same seats, right? Yeah. But okay, that's a different kind of conversation. But basically what happened when either COVID, the war, or something kind of like black swan-y type happens, right, in the markets, valuations crash at the stock market level. There are other macro headwinds that folks don't know how to underwrite. And the things that kill a deal is just uncertainty and time and delay, right? You have to get a VC deal done. The thing is hit them hard and then get the deal done in like 3 or 4 weeks, basically, in a nutshell. Time delays everything, and the more people think about a deal, the more they start kind of worrying about stuff, and then the lower their confidence level kind of goes. And so the whole story behind what happened was that when the war started, that was kind of linked to, okay, stock market is crashing, people were fearing kind of economic recession, they were fearing squeezing of discretionary income and what that means for consumer environments. I made the same arguments like, kids are born all the time, parents, and we were just branching out into like prams, bicycles, a lot of like necessity stuff anyway. And frankly, business was going quite well for us even in March after the war started, because we were the more cost-effective way. So if you're trading down from buying toys, you came to us. So actually we thought we were quite recession-proof anyway, and the numbers were showing that. But it couldn't override the kind of like macro kind of headwinds that folks were worried about. What's going to happen long-term to inflation rates, interest rates. And to be fair to them, they underwrote it correctly that if inflation went up as the way it did, like our economic margins would be compressed heavily. The capital efficiency of the business was quite intense. We had to spend a lot of money on stock, on warehousing. And if cost of capital goes up to 5% as it did, what's going to happen to the business? But the ultimate thing that kind of undid it, James, is the whole story behind it, is that Q2 2022 was rife of stories where VCs were looking for all sorts of reasons to not do a deal. And you might even hear of stories people pulling out of deals and whatnot. And what happened to me happened to a few others. I hope it never happens to any of you. But we had VCs basically change their minds at the very, very last second, which really killed what was really quite a fragile round. So I openly admit that the round we were trying to raise, it was a nice number, 50 million pounds, but it was comprised of like 3-4 new VCs, all of them doing 2 million each, 3 existing VCs. So a lot of different parties doing a sizable round rather than one big party having high conviction. And so when people started wavering, when one VC started saying that we wanted to pull out, it's not as though one VC pulls out and you can still complete a 12 million pound Series A without them. It creates this cascade of kind of like confidence, right? Of knock-on confidence. Oh, why did that person pull out? Maybe they saw something we didn't, and therefore we're going to pause or pull out as well. And the real issue behind all of it was that the sudden turn of events meant that we didn't have a lot of cash runway left when we were kind of like in this position. We had runway, and this is one of the most frustrating things about me for about the Whirli experience. Like, we had always planned to raise in Q1 2022. So we planned for runway to like July, August, in a nutshell, but consider 6 to 9 months remaining. We started going out to market. And then we also assured by our current investors that if things took a little bit longer, we'd get convertibles in early at the terms that wouldn't be an issue. So don't worry about it. Keep pushing hard. Keep your marketing budget. Even in March, April, when things were collapsing, I was still told to like keep your foot on the gas and keep your marketing budgets where they were, right? In a nutshell. And then those promises didn't convert at the end because obviously some of these promises were made when the market wasn't blowing up, basically. And so it's one of the things I always say, like, look, if you make a promise, you have to honor it, especially if the market blows up. If the promise is not valid when the market blows up, then what the hell is the point of it? Of course, if the market is good, I was going to get funded, right, in a way. And so that was a real frustrating kind of like learning for me, and it's caused me to, between my first venture and second venture, got a lot more cynical about kind of like investor behavior. The one thing I tell all founders these days is always remember all your investors are diversified. As a founder, you are not, right? You spend your life and soul into this thing that you need to make successful. Your investors, you're one in like 25 or 30 in their fund vintage, or even more than that, right? They are very happy to write you off, basically. And your incentives are not aligned in as much as you think they are. That's one of the big learnings for me as well. So one of the funds kind of pulled out of the deal. It caused a cascade impact. It caused the second fund to be like, okay, I'm not sure we can do this now. We then kind of like rescue a smaller bridge round, and there's quite a bit of noise and drama kind of behind the scenes, but in the end, we just couldn't find a way to make it work. Even as a management team, we thought about, okay, why don't we like go do management buyout type of things, because the business itself was fundamentally quite good. We just needed more time to figure out an exit, just needed more time. But even for us, we got to a point where, look, we couldn't see us raising the capital we needed and wanted to really scale. It was a more capital intensive business model at the end of the day. And we decided that at the end of the day, the most precious resource is your time and the time you have in your career. So we couldn't see ourselves putting another 2 or 3 years into this, given where the market was going. And so we sold it. It was a distressed sale. The business still runs today. The person that bought it from us still runs it.
As Whirli?
As Whirli, yeah, very painfully to me. They once spammed all our customers, and I got a lot of complaints about that. And I was like, guys, I sold this business, please stop it. But literally mobile phone spam, and I got it as well because I was a test user. So I was like,
Just say what happened to the business you sold it?
Sold it under administration. So it wasn't a very good sale. It wasn't a very good outcome. And again, it was because we didn't have time to do a proper sale. And that was the most painful thing. I think, look, if we had enough time left, we would have still managed to sell it for something decent. It wouldn't be like a retirement kind of outcome, but at least...
Did you say what you sold it for?
Yeah, a few $100K, not much.
Did you think about buying it back then?
So the new owner actually wanted assurances from, well, not from me, but he asked the administrators whether they thought I was ever going to compete again and start another business in that space. But no, I do think sometimes about whether I would go back to that business model at a later point in life. We especially, having had the 4 or 5 years experience running it to now know how to do things differently and better. Maybe at some point. I'm not sure I'll buy it again because I think they've destroyed the brand too much. I try not to go on the Trustpilot for Whirli these days because we held like a 4.9 star of like 1,000+ reviews or something like that, and I just try not to think about it. When we had our boy 2 months ago, and
You're 4.6 now, it's not that bad.
is it okay? Oh, it's not that bad. So maybe worth putting a bit on it.
Keep them on your side, Nigel.
But look, it was quite interesting because I became a dad 2 months ago. I had my first kid. Thank you. And we were thinking like, And look, for the first week we were home, I used to remark to my wife, like, shit, I feel like I solved this problem already. Why is there so many boxes? Why are we spending so much money on this stuff? Literally solved this business problem and built a business around it like 6 years ago. And at some point, even I got frustrated about how much crap I used to joke with her, like, I feel like I'm living in an Amazon warehouse. There are boxes everywhere. Every single day you're sending me to go open a new box of something that we needed for a baby and we're buying even more. So I did say to her, like, babe, if you really want, sign up to Whirli. I don't mind it. And she was like, I never do that to you. And I was like, oh.
Okay, good. Just sign up to Hey Alfie then. So let's dive into how, if possibly, this could have been avoided. So if you're going through it again, which you are, which is quite a good case. So starting back at raising your earliest rounds, what would have been done differently in the first raises and leading into Series A?
Yeah, look, I think Whirli was my first foray into the venture space. So I was quite green and fresh into this whole idea of like, what makes a VC backable business work? What do VC investors look for and everything else, right? I built the business that I was very passionate about. People describe it as a mission business these days, and mission businesses are a double-edged sword. Some VCs don't like it because mission-based businesses don't make enough money, basically. And VCs are all capitalistic, right? They need to make money. Even the ones that invest in mission teams need to make money, right? And so I was a mission-based founder, and the mission was solid and strong. And we built the service in the way that I thought was needed to really fulfill this mission. And that resulted in quite a capital-intense business model. So when we looked at the market, for example, one of the biggest decisions we made was that we saw that there was no way to deliver the right kind of customer satisfaction experience and service if you didn't own the operation yourself. And so we invested to actually have the toys on our balance sheet, because the toys on the balance sheet meant that we could create the right kind of like quality assurance of the product going out to market. We invested in having our own warehouse because we knew, for example, that not even Amazon knows how to do a returns process. So in the long term, if we could do a returns process at scale that managed the sharing economy, this was super defensible, but also super valuable to the business. And so we had capital intensive that way. And the result of it as a mission-based founder was fantastic to me, right? Like, one reason why we had such strong talent attraction, and even the folks in our warehouse really loved working at Whirli, is because so many parents would actually send like thank you cards back in their returns. And it was so heartwarming to see parents who say like, oh, you're struggling for Christmas, but with a Whirli subscription for like 20 quid a month, I'm able to afford these toys for my kids. Fantastic. And then the VCs just looked at the P&L and they're like, oh my gosh, you spend so much money on your warehouse. You spend so much money on dispatching. You spend so much money on marketing. You spend money on all of these kind of things. And it didn't really matter to them that, I always say like, look, I raised £4 million and then I built the business to a 2.5 million ARR. The capital efficiency at the macro level is fine, right? But they looked at it just from a thematic level. And the thematic level is that VCs hate spending money on these kind of things. They like more tech-enabled, scalable growth. So it didn't matter to them that I compensated the capital intensiveness of my operations with a leaner overhead team, with a leaner kind of engineering team. So one thing I did differently, and that's why Hey Alfie is an AI native kind of marketplace business. It's just thinking very carefully about like, look, I now know what VCs are looking for. They need to see that capital efficiency. I know what they like spending money on. My kind of like P&L today is mostly kind of like engineering salaries and kind of LLM costs and not much else. Basically, it's a high gross margin business. And so there's a bit of like learning from me there. Like, look, as a second-time founder, I now know what the market is looking for and what kind of like themes they're looking for, what kind of P&L they're looking for. And I've crafted the Hey Alfie business model around that as well. I think it's one that I joked earlier, but genuinely, like one of my biggest learnings was always be raising. We actually did have options to raise in 2021, and we declined them politely, which is one of my biggest maybe frustrations, maybe slight regrets. But for those of you who were active in 2021 was a completely bonkers market. Like lots of companies that weren't hitting milestones or benchmarks that they needed to were raising incredible sums at inflated valuations. In a nutshell, we did our seed round at the end of 2020, and we always plan to do the kind of fundraise in 2022 for the follow-on. At some point during the late 2021, we had quite a bit of interest. Even tier one funds were offering to come see our warehouse, which for me is always, because the warehouse is like in the middle of nowhere. So you're going to get a VC person to go from Mayfair into like all the way out to Greater London to a warehouse. It's always a strong signal of intent for us. But the feedback I got from my board, and maybe again I was being too polite in listening to my investors and board, was to hold them off because Christmas was around the corner. You grow the business at Christmas, we justify a bigger valuation. Don't worry about whether the market goes because we'll guarantee your convertible for you, etc. And that's again like maybe as a new fund, I took that a little bit at face value, not realizing that obviously VC investors will always want to push on the uplift on the valuation. So they're always trying to try to push you to the very brink, deploy all your capital to juice up the P&L so that your next round is going to be as high of a valuation as possible. But so yeah, I mean, in kind of like October and November of 2021, we didn't actively fundraise, even though we had inbound interest. We politely told people to come visit the warehouse when it was quieter in January, February. It meant that our fundraise got going 2 or 3 months later, and then we got caught in the really bad timing. And so these days at ALFI, I'm like, any VC reaches out to me, I'm open for conversation. You talk about fundraising, I'm like, yeah, whatever. Right? I always take money at a good valuation, basically, right now at this point in time, and so, as I was saying earlier, like ALFI, we raised quite a chunky pre-seed in March this year. We still have like £2 million in the bank, but we're already discussing with folks like when should we do the next round. I'll happily do it as early as in the early of next year, even though we have a year left or a year. It's actually going to be like 15 months of runway still from that point in time. It's just like that mentality of always be raising. I think some of the best founders do very well, especially in the US. They raise round after round very quickly for this reason.
What about the difference between raising that seed? How do you go differently now about this next round?
Yeah, so we were just chatting earlier about like narrative-based fundraising. Narrative-based fundraising is the name of the game. At Whirli, we were very metrics-driven, and I was just wanting to build a solid business, and my numbers were fantastic. My retention numbers were best in class, basically. A lot of VCs were like, I've never seen retention numbers like this for a consumer subscription business. And we went out very strong on that kind of like, we've got a solid business. The narrative around it sucked. And so when we went out to market, we didn't have a good way to get VCs very intuitively understanding what we do. And that for me is another learning as well. It's why you hear in the market bias and diversity in VC investors causes real issues with startups. When I went to fundraise, because of the nature of my business, and the nature of how the demographics of VC investors, not a lot of people understood it, largely because a lot of VCs are still run by men, and some of them just don't understand. They would ask me like, I don't really even know if this is a problem. My wife handles all of this stuff. I had one VC, this is actually the chairman of the fund, and his legal counsel was on the call when he said this, but we talked about how like cost savings and budgeting was a really important factor. And he was something like, oh, if it's all about money, it's quite a difficult calculation. If target demographic is usually moms, would they really get that? And I was like, yes, women know how to run budgets in their homes. And so there was this real eye-opening thing for me as a founder. And you speak to, but in the consumer space, I'm very close to like a lot of the other consumer founders, and some of them will experience all these challenges. If you run femtech, health tech, whatnot, VC investors don't have a lot of time to DD a company. And so when the narrative is hard for them to understand, they don't, like the Whirli thing, they didn't even understand the scale of the problem. They didn't even understand the TAM because they don't deal with that category. Someone else, if they have kids at home, deals with it. And the problem I had as well is that you're a first-time founder, a lot of my intros to associates, and the associates weren't parents. So none of them even knew about this concept of this problem that I was trying to solve. It became quite a hard kind of sell to even get the follow-on meeting, basically, right? And there was no comparable in the market. Right? People couldn't underwrite how is this business going to grow, what's the narrative around it. They usually liked it when we got to slide 10, and slide 10 was like our ARR chart going that way, right, basically. But then the kind of slides before that, they just couldn't really understand it very well. It took them quite a bit of time. So one thing we do differently at ALFI is that we're very hot on narrative-based fundraising. And yeah, I've seen night and day difference, right? Because the VC demographic hasn't changed the last kind of 5 years. But I go out to them now, I'm like, hey, property management's a pain. And they're like, oh yes, I'm a landlord of like 2 properties and it's such a nightmare. Oh, I have a high value home and it's such a nightmare. Like they understand that problem firsthand. This is one of the reasons sometimes why, if you look at the market, you see some businesses getting funded. They're very niche businesses. They're niche businesses for like, more affluent folks because VC investors understand those problems better, basically in a nutshell. And so we've got quite good and much better when we go out to fundraise. How do we talk about the overall narrative and frame it in a way that's so tangible for the investor? Like if you look at what we do at ALFI, everyone's got a story about how some home renovation messed up or how some tradesperson tried to scam them or whatnot. And very easily, within like 10, 20 seconds, they understand the problem and they understand the scale of the problem because they know they spend thousands of pounds on this stuff themselves.
would your advice be then if it is that, say, your item, your product, your app, whatever it is, actually is something that maybe the VCs wouldn't understand? And if it is a VC model, what's the best approach? Is it actually, would you suggest to go to angels still over that?
I think you need to simplify massively. So again, at Whirli, one of the things that I reflect on is that we run quite a complicated service business model. Like, so if you're on the website, the way it runs is that you sign up to a service, you get a number of tokens. The tokens determine how many kind of toys you can borrow and whatnot. And we did all of that to construe the best customer experience possible. But when you try to explain it to a VC, they're just getting lost in the detail. They're very confused. So what you need is that VCs operate at very stratospheric levels of understanding things, right? Even after they invest, by the way, you don't expect them to know your business kind of inside out. They operate at that kind of stratospheric level. And I was trying to explain and give them a narrative at the super granular of this is how my service works, this is why kind of like customers love it, this is why you get good value for money because £20 a month gives you X amount of tokens, blah, 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 blah. They get lost on all of that. So my advice would be like, it always helps massively to extrapolate and simplify, and like how do you get it to that classic 30-second elevator pitch where it's so simplified enough that they understand it best, and try as hard as you can to find a comparable in the market that's doing well. This is why people use a lot of analogies for we are the X for Y, we are the Booking.com for this, we are the Uber for that, blah, blah. Because that helps VC in one sentence understand, oh, okay, it's the same business model, this is how they make money, and they could get as big in the same way. So I would say like, simplify, getting your message as simple as possible is the thing to kind of think about. Try to be able to explain it in like 3 or 4 sentences so that when you send an email for introduction, the blurb has that 3 or 4 sentences that's so simple, so intuitive for them to understand. Not to disparage them or anything, but you just basically don't want them to think. You just want them to read something and be like, oh, I want to intro to this company, just from that 3 or 4 sentences. My blurb was like, they had to think for a bit, they had to go to the website, and they just not got time. You just want them to see those 3 or 4 sentences, reply, yes, make an intro. That's it.
There's one more topic I want to dive into, just off the back of our survey, and then we'll open it up. So if you want to dive more into fundraising or the round collapse or wherever you want to take it. But the last thing I want to touch on is team. So when building out a team, for you, and again, thinking about your new venture now, what are the few first roles that had the biggest impact and where you sort of focus now?
Yeah, so I started Whirli as solo founder, and then at HRV I've got 2 co-founders. Controversially, I don't believe in equal co-founding stakes generally. I think you need this classic CEO, and you need kind of like co-founders that have material skin in the game, but you can't paralyze decision making. Part of this is a reflection of like, I've seen too many kind of co-founding teams where they just run into issues as well. It goes very against the grain of kind of VC thinking, so I appreciate it's not for everyone. There's also some VCs question my thinking on this quite heavily, but whatever. When I started Whirli, I came off a corporate career. I didn't know anyone that worked in technology that wanted to join. I actually went out to look for a co-founder, and then I was like, oh, maybe I try find technical co-founders, what everyone suggests. Maybe I try incubator, whatnot. At the end of the day, I couldn't find a partner that I thought I'd be willing to give half the business to in an equal co-founding way. Even in like a non-equal 70-30, 60-40, whatever. Just found that quite challenging because for me, I think if you work with someone at that kind of level of partnership, I like it for it to be someone that I've known for a long period of time, not someone that I just met for. But that's my personal preference. Anyway, folks think about it differently. I think I don't think there's a kind of easy answer to this. I don't think it's right to say be like, oh, you guys all need to hire AI engineers, or you need to hire marketing and whatnot. Again, for me, it always comes down to have a very clear idea what your next fundraising milestone looks like. And I would say like for founders, the most important thing is actually to know how to fundraise, basically. Based on what those fundraising milestones are, decide what skill sets you need to hit that. So don't take this kind of cookie cutter approach where if you're an AI company, you're just going to hire AI engineers en masse or whatnot. But sometimes actually what your pre-seed investor wants to see is some level of customer traction, and you actually needed to hire a salesperson for that whatnot. Again, this has come with experience in the second time, but we already know what we wanted to do for the pre-seed. We closed that quickly. We know what we wanted to show for the seed, which is why we are closing this, hopefully the seed in kind of Q1. We know how to close that. We actually roughly know what we think our milestones are for Series A, B, C, right? So we know what we need to do on all of that. And it's by looking at the milestones and evaluating your team that you can determine what's appropriate for your specific business at your specific stage. I think the cookie cutter approach might lead you down the path of like investing in a specific area that actually wasn't a concern from the VC investors, and then you find that you haven't invested enough. Bear in mind that in between fundraising rounds, you don't have a lot of time to make mistakes, or you don't have a lot of time to waste. And so once the clock starts running for your first institutional round, you kind of want to raise the next round within 18 months, ideally within like 15 to 18, 24 at the very kind of max. And so sometimes like, look, takes you 2 or 3 months to find a good candidate. In the UK, they might have to serve a notice that might be 2 or 3 years long. If you wait 6 months for a critical hire and it turns out that was not the critical hire you needed to make, you just don't have enough time to make the actual critical hire you needed to make and have that person deliver on the mission for you. And so that's why I think a lot of it comes down to your primary role is to make sure you can fundraise for the business. Speak to VC investors a lot to understand what these milestones are. What is your next fundraising round milestone? What is the milestone after that you need to show? Speak to a few friendly VCs about this. Try to pitch to some VCs that you don't care for to just get their feedback as a bit of a testing run. And once you nail those things down, it'll be easier for you to map like, hey, I've had 3 VC conversations. To be honest, none of them will worry about the product technology. They want to see customer traction. So maybe I shouldn't be hiring that product person I thought about hiring. I should be hiring a biz dev or account executive type person to show that traction. Or maybe it's the converse. Or maybe they thought about something that you hadn't thought about before. Though the VCs really wanted us to get on top of this, but we don't have anyone on the team that knows this well. And so I need to make that hire. So that's how we go about things generally. But the end result tends to be unsurprising. Like for us, we started a lot on actually designers, frankly, because again, in Hey Alfie, narrative-based fundraising, the first person we brought on was product and design because Richard designed the Figma thing and fundraised off the back of the Figma as well. Then we hired engineers to actually build the thing we promised that we were going to build, basically. So we didn't start engineering first. We actually started product design first, which is quite unique. And then we started hiring growth people because we knew that the seed fundraise was going to be based on early traction. So once the term sheet was signed, before even the money hit the bank, we went out to market to say like, okay, we know we want to do X, Y, and Z for the seed round. The gaps we need to fill is that we need a growth person to come in to show the traction. We need some humans in the loop to manage operations because frankly, the AI thing wasn't going to work perfectly when they got out of the gates. And then we needed 2 more engineers to build enough features for us to get out to market. So I say just think about the fundraising milestones and do everything based off the fundraising milestones backwards, even in the way that you build your team.
I'll tell you what's quite interesting throughout this. There seems to be a conflict between doing everything for the VCs and making sure you get through the milestones like we've just talked about, but actually pushing back pretty strongly on certain things. So equity in the business between co-founders to owning the product and the warehouses and whatever else in Whirli. And so it seems to be striking that balance. So I find that interesting.
I think like VC investor sentiment management and narrative management is quite important. Even for us, we have major strategic decisions. Why do we have both a B2C business and a B2B business at Hey Alfie? People find that quite confusing and people find that quite maybe overly ambitious. We're stretching ourselves thin. But we have a whole narrative around the fact that we want to own every single residential home, and 60% of the market is home owner occupied, 40% of the market is rental. So we think it's actually quite important to have both, and the synergies in both are quite important. I think if you have the luxury of being able to choose which VCs you work with, like strategic alignment for me is probably one of the most important things. And like strategic alignment plus just getting a feel for. And one of the reasons why we took the money from Lakestar led our pre-seed as an investor I've known for like 4 or 5 years now because he tried to do my A round at Whirli. But one of the reasons why I like him as an individual personally is that he gives the right amount of challenge I'm seeking as a founder, but he always caveats challenge like, but you're the founder, this is just my opinion, you know the market best, whatever you do, I'll be supportive. And that's the kind of balance that I like. I don't really want a VC investor that doesn't really know my market that well to push me in a direction just because they heard about it from somewhere else. Right? Even at Whirli, I used to be close with the other companies in the portfolio who share the same investor director. And we sometimes joke and compare notes like, how was your board meeting this quarter? And I'm like, oh, person pushed on branding. They should do the same with you. And we're like, yeah, pushed on branding with me as well. And that was just the flavor of the quarter, like going around to all this. Probably something happened in the press where brand became really important. Then it went to all their portfolio companies pushing on brand. And you see all the same things happening. Like VCs are so thematic, even with portfolio management. And so, a year and a half ago, some companies said everyone should return to the office, and in the US, they're all doing that. And so all VCs push their companies to kind of like get everyone back to the office, just because something's happening in the macro as well. I push back on that, as I was mentioning to you. We are not all in the office. We're only 3 days a week in the office. But yeah, so it's that delicate management and relationship management that I think is quite important.
Very cool. Well, I'm happy to open it up. So any questions?
Yeah, just wanted to ask, your point about always be raising your best learning was quite interesting, but how do you think about managing your equity if you're doing that? Like, are you basing it on your exit strategy? Do you have a figure in mind? How do you kind of balance that?
Yeah, look at, I think one VC actually told me not to say this, but I always think like, I said once like, I don't need to be a billionaire, right? Like, I kind of like, I was joking with someone like, I don't need to be like private yacht rich. Maybe just need to be business class rich was the joke I made with this person. And the reality is that, as I say, like as a founder, you bear a lot of risk in any scenario where you get a meaningful exit. To me anyway, I'll be comfortable enough. I lead quite a reasonably frugal life with my wife. I don't spend a lot. Right? So again, I don't personally. So that's sort of my personal philosophy anyway, as I'm de-risking a business to get to even just a decent exit rather than putting all my eggs to try to get to a super kind of phenomenal exit. Now, I think the caveat of always be raising is like always be raising and only take money if the terms are good. Don't take money on bad terms. Don't take money with funny stuff in the term sheet. Whatnot, that kind of stuff kills. But it's just that mentality of like always be available for someone to like don't turn money away basically. I think it's good to have a strong reputation and presence in the VC ecosystem, and when you're constantly out on the market, it helps. I didn't do enough of that at Whirli because I was the sole CEO founder. So if I was fundraising, basically nothing happened with the business. I now have a quite good, strong team around me. So actually, yes, I'm here today, this morning, like the business is progressing meaningfully without me. Sessions are happening, like the team is building stuff. And if I'm out fundraising, stuff is progressing. If I'm out paternity leave, stuff is progressing as well. So I've built a team that given me the luxury to be able to be in the market a bit more. And that helps the business so much because I have my ear closer to the ground of like, okay, what are VCs expecting for our next fundraise? And you hear a lot about like fundraising tactics about the best way to fundraise is to pretend you're not fundraising, right? Classically, kind of thing. So I go around the market all the time being like, oh, we're super well capitalized, but the next round's going to be competitive. So if you want to get in a bit early, hint, hint, wink, wink, that kind of thing, right? That's stuff that I've learned kind of like from other founders, now being a second-time founder as well, versus an approach of like, hi, nice to meet you. Here's my pitch deck. I'm looking for X amount. That comes across a little bit too desperate. And it's a bit, they always joke about VCs like dating and marriage. Like, that just rubs off the wrong way. Whereas if you're going out, be like, oh, look, I've got so many suitors. I'm so interesting. People want to talk to me all the time. I even say stuff sometimes like, oh yeah, I'm happy to come down to your office because I'm in the city for other meetings that I'm meeting other VC investors that day, kind of thing. That kind of like thing helps build the reputation of the company and just get the FOMO going so that by the time you either have a term sheet, you can go back around to them and say, hey, remember I came around 2 months ago and I said I was meeting other people. Someone actually gave me a term sheet. Would you like to do something here? Kind of thing. And so that's the kind of like always be raising kind of mentality and some of the tactics around how you manage that in the market, basically. You don't want to be like always be desperately needing money, basically. If you go out to market with that kind of message, it kills you massively.
Rebecca?
Did you first start with sort of friends and family in pre-seed and then move on to and then angels and then move on to VC? How did you start to penetrate that VC sort of community? What were the first sort of moves you made to do that? So in my first business, I started with friends, family, and angels and folks that I knew. Partially because coming back off my corporate career, I knew a lot of high net worth, high income individuals who all love SEIS and EIS and want to invest. For us, it was a capital intensive operation. So I also thought my equity was best preserved if I raised some angel money on a convertible, proved enough to then do a big kind of institutional round, like £4 million institutional round. And then at Hey Alfie, we went quick and faster to VC. So at Hey Alfie, I put some of my own personal money in, the other co-founders did, and then we built the prototype with that in 2-3 months, and then we went to raise VC money. So we raised only like 200K or something like that of our own money plus angel money, basically. And I think that's a reflection of the first time around I did this. As you say, I didn't have a strong network with VCs, had zero reputation, zero credibility. And so I also wanted to budget more time to go out to market. So I raised a bigger angel round to give me more time, to afford more time to do that. And then when I started trying to get introductions to VCs, it always, classically, you want to get warm introductions to funds that you like. And a lot of it is just being very smart in your network of like who could introduce you to someone that could introduce you. Sometimes it's 3 degrees away, right? You need someone to introduce you to someone else that could introduce you to the other fund. Sometimes it's very nice to go out to a VC fund that doesn't operate in your sector and just impress. So I even reached out to like folks from management consulting, like they went to VC funds that don't invest in my stage or my sector, because VCs like introductions from other VCs, kind of thing. So I went there. Then obviously they knew my reputation in my corporate life, and then they said like, "Oh, I happily make that introduction for you," and then they made that introduction. And then even VCs that turn you down, right? Ask them for introductions elsewhere if they're willing to. Some of them are willing to, and that always helps. And so, over time, what did help? The person that invested in Whirli at the end was a mom herself, and so she had known about the business, and so we had success there. So the brand does help if you get a VC investor through that way. And then over time, when after you do your first institutional rounds, it gets easier. The networking just gets easier. It just does have literal network effects, right? So once people start introducing around, it's much easier to penetrate the sector. By the time we did our seed round, or even as we go for a Series A, I could get introduction to any fund I wanted to. And then likewise, then I just kept in touch with a lot of them. So the second time round, this is the benefit of being a second time founder. Despite what happened at Whirli, I maintained a very strong reputation with the VC kind of ecosystem. So a lot of them proactively reach out to me. I don't really reach out to them as much these days. And even today, I feel to be in a fortunate position where, as I raise my seed between my existing investors, the people I've known in the past from Whirli, whatnot, I could virtually get introduction at any seed level VC fund that I wanted to, and it'd be quite a strong recommendation and introduction as well. And so I think a lot of it is about managing your reputation in the market and using that reputation to leverage a network to make these introductions. And once you have enough of penetration, it all gets easier from here, because the UK is just not a big market at all. Like a VC fund, even a tier 2 kind of VC would know all the other VCs in the market already. So as long as you get one person willing to make those other introductions, you can penetrate the market very well.
Andy?
I might have misheard you, but did you say your pre-seed was 2.7 million for?
Yeah.
So what pre-seed in my head is I need money to build a prototype for a concept.
Yeah.
So what were they backing when they put in 2.7 million? So what did you? The narrative I understand, make it simple, get on the easily. But what were you showing them? Was there any traction at all, or was it?
Part of it's just that, especially in AI, we just operate in the hot market as well, right? And so, like, even when the way to do things properly is that you need to figure out how much money you need to get to your next round, and to manage dilution, you take what money you think you need to get to the next round, basically. But us being a bit more cynical, myself, co-founders, we were much like, look, every other AI company is raising like 2 million, 1.5 million in their pre-seeds. So if you want to signal that we are better than them, we need to raise more than what they did, basically, right? So, and so how do we backstop for like raising more than them to signal that we are better than them? At the end of the day, the VC market operates on signals. You hear this term a lot from VCs, signaling. One reason why companies are now raising quite sequentially faster is because of the signaling. If you raise your pre-seed, then raise your seed within 12 months rather than 18 months, it signals that you're going very fast. If you raise your Series A within 12 months rather than another 18 months, again, it signals that you're a very strong company with a lot of investor interest. And it then snowballs, right? That by the time you get to the Series B, all the Series B investors are like, holy shit, these guys raise their rounds every 12 months. If we don't preempt and get early, someone else is going to take the round before we even talk to these guys. And so signaling is like the name of the game in narrative-based fundraising as well. And to be honest, like we kind of went out again, not to disrespect some of the other founders, but we're like, all these slightly mediocre teams working on mediocre projects are raising 1.5 billion in the AI space. We should be raising 2 million plus. So I sought to raise 2 million plus, literally my seed that it says 2 million plus. And then it got a bit overcrowded, and then it became 2.7 to manage everyone's kind of like...
What were you selling? So
huge market.
Pre-seed.
Yeah, huge market.
But
yeah. So at pre-seed, it's always about just market and founding team, largely.
Nothing about traction. No product demo.
We had a Figma prototype. So,
and what was your valuation?
Okay, so the other thing that I do, the VCs like about me, is I do not care for vanity metrics. Basically, I do not care. Like even if you try to look at, I spend very little time on LinkedIn. I think LinkedIn is like one of the most toxic places in the world. It's worse than Instagram. It's worse than all the other social media. Like genuinely. A fun anecdote is that I was once complaining about this to a friend that works in the charity sector. And LinkedIn's a bit like your YouTube algorithm. You can tell a lot about the person based on the feed, right? Because she works in the charity sector, her feed was so wholesome. It was like everyone's talking about missions and doing good, whatnot. And my feed is full of VCs blowing hot air about their thesis on this, their that, founders chatting shit about how good their startup is doing. It's just super toxic, right? I try not to participate. So you find that I'm actually, one of the criticisms levied at me is that I don't do enough hype stuff on LinkedIn. But it's partly because we're semi-stealthy, so I will unashamedly be more active on LinkedIn from next year onwards and start posting a lot of crap. And so please don't judge me for it. Just kind of playing the name of the game. Just playing the name of the game, right? I'll be talking about how AR is growing, whatever, building.
Whenever you post, I'm going to put a clip of this in the comments.
Exactly. I sold my soul.
Yeah. You had a question at the back.
Thank you. Firstly, Nigel, congratulations on your son.
Thank you.
So Press the Examiner Limited, my wife and I run, and we've had 8 years of traction. And your point just blew my mind, if I'm honest, because to think that what you're saying is we're fairly small, so 60 to 70 schools, regular customers. We're now going Press Digital as from last Friday. So that then, the market then just obviously goes huge. We've got people speaking at conferences in Dubai and Qatar in January. So I'm speaking to James after this about some of the things you said. I don't know, if I'm honest, I find it really difficult working in my own team, let alone having another couple of people in there who will tell us what to do. So I don't want to be, frankly, in a situation where we get the wrong partners or investors. How do you manage that to ensure that you keep sane?
Yeah. Look, there's a little bit, there are a few angles to this. I think, firstly, from a formal governance perspective, it's going to be important to also get very au fait with how the board decision making runs. What can you do as the exec without board approval or anything else? One of the things that we managed to negotiate at the pre-seed is that we actually have 2 director seats from the company and the investors only have 1. So we actually have more director seats than them. Of course, they have the investor director consents and everything else, but we added provisions successfully where the fund also can't replace the director without my permission. And so, because this happens all the time, you raise money from a fund, from a partner you really like, that partner moves on quite shortly after, you get a new partner placed onto your board. That new partner never looked at your business, it's not their baby, they don't care for this investment, they have some things that they want to push you down on, and you get the major misalignment. So one thing we negotiated and got as well is that if the investors want to appoint anyone other than the 2 people I've okayed at the pre-seed, they need my permission to appoint them, basically. And that gives me control of the board, generally. We're also now very good at literally being to the line of if it is not stated as an investor director thing, or if it's not stated as an investor majority consent item, we take free rein to do it. I'll inform them our politeness, but I'm not asking for permission here. And when I was a first-time founder, I was a bit more polite with the board in that way. And I was like, guys, we're all going to be happy. We're going to build consensus. We're going to make decisions this way. Whereas now I'm like, okay, there's a decision that's IMC consent. I need your consent. But frankly, I'm going to tell you to consent. And then that's why I like this guy. He will consent. But then if it's not, I don't even ask. I just do. Right? And that gives us a lot more leeway, so that a flexibility to basically have a lot more control formally from the governance standpoint, where we don't feel like we have to report every single decision up to the board. So even recently at Healthy, we made the decision to onboard some first-party services, which is slightly controversial because we're getting a little bit more operationally heavy. And by that, I mean we actually onboarded a handyman, we're onboarding a plumber, because the economics in that business is actually phenomenally strong. And if you guys hear of companies like Pinnacle Plumbers and whatnot, these are actually very highly profitable big businesses and very old school, easy to attack. And as we were building the strategy, we were kind of as a team, oh, should we tell the board we're doing this? And I was like, yes, we should tell them, but not really asking for permission, basically, right? So there's one thing in the formal governance, we looked at it, it's look, this doesn't need the formal. We're going to tell them, and they all backed it anyway, so we minuted that they all supported it, but we're going to do it regardless. We're just going through the theater of telling them and getting them to kind of approve it. So I think one thing from a formal governance perspective, be very careful about making sure that you limit the consent requirements that you need, and that you also control the board so that there's less that you need to do formally. Now, I think informally, outside that governance structure, a lot of it does come down to relationship management with investors and the type of investor you're onboarding. The good thing is that VC investors, I don't know if you see some of their LinkedIn, they sit on 6 portfolio boards, they do investing on the side. None of them have any actual time to think about what to micromanage your business for you. That's okay. At Whirli, one of my reflections actually is that I think Whirli should probably have been a PE-backed business rather than a VC-backed business because it's not a VC kind of model. But obviously, PE companies take a very different view. They take a bigger stake. They're more active on the board. Some VC investors are just generally have a reputation for being more micromanaging and whatnot. So make sure you do your diligence, not just yourself, but always ask to speak to other portfolio companies that they've invested. Not a portfolio company that they've invested in the last 3 to 6 months, because frankly, even as a founder, if I just took money from a fund 3 to 6 months ago and they want me to do a reference call, I always say nice things because I kind of need the goodwill kind of thing. Try to get a portfolio company that's at least one investment stage behind, right? So like 2 years away, and then you'll be like, hey, I want to ask you, did they micromanage your business? How did you? I always ask, how do you manage any kind of difference of opinions on strategic alignment? And how did and what I always like to hear is them saying the investor just told us to get on with it, basically, rather than getting involved. And so I think those are the more kind of informal kind of relationship tactics to kind of employ. I'm a bit less afraid of also putting my foot down. So sometimes there was actually only one second this is about comp for the team. I was like, comp is important, obviously. But I was like, this is just going to happen. Like, if this is going to work, you're just going to say yes to this, basically, right? And I've learned that from seeing other founders who, frankly, are more direct than I am. I've spent enough time in this country. I'm quite indirect and quite kind of polite in the way I frame things. I'll be tiptoeing around issues. And then I hear stories from other founders where they're like, and one founder even told me that he told a fund that if they did something, he was going to tell the whole market and go to the press to tell them that they did that. And then the fund backed off, basically. So like that level of like bluntness and ruthlessness is more to their language and they respond to that well. Obviously, go nuclear only on issues worth going nuclear about. But but it's just a learning for me of like, it's okay to be a bit more blunt and a bit more kind of like forthcoming of like, hey, you guys backed me, I'm the expert here. I know you want to say this, but you're wrong. I'm going to do this, and this is the way it has to be. You can't micromanage the business.
Okay. We have a couple of minutes, so just one more question. Go for it.
I was just going to ask, would you recommend then, what's your opinion on going for, say, fundraising? Would you actually try and sort of focus, if you can't, on, not going fundraising, focus on internally going to angels?
So I think the main thing about VC fundraising is because coming back to that point about signaling, once you announce a fundraise, or especially an institutional fundraise, the clock is ticking, so to speak. Like then people start measuring how long do you take to the next fundraise. So one of the reasons why I haven't posted anything on LinkedIn. Right? So actually, most people don't actually know that we raised quite a sizable round, and my investors keep asking, can we publish our why we invested in HeyAlfie memo? I'm like, no, you can't, because we don't. And the reason for that is because it helps me manage expectations in the market. And so I always say, like, don't rush to your first institutional fundraise. Don't rush to do things too publicly, because once you start doing things publicly, basically you're setting yardsticks that everyone else in the market can measure you against. Like, oh, if you raise your pre-seed today and then you haven't raised in 18 months again, then it's, again, signaling, right? And so for me, the time to fundraise is when you are very clear, you understand how you're going to manage the next 2 to 3 rounds. You know that if you take this money, what you're going to do to get your seed round in the next kind of like 12, 15 months, what you're going to do to get your Series A in another 12, 15 months after that. And it's not worth planning beyond that. Most kind of early stage companies just want to get to the Series A. Once you get to the Series A, you've got enough product market fit and enough money to make things kind of work out reasonably long term. So I think the question to ask yourself is like, will you be ready for the clock starting? Because they take the money. And if you're not, it's worth taking smaller amounts from angels because you don't announce angel rounds anyway and no one really cares about them. Or it's worth bootstrapping for longer or just trying to do things on a leaner team. So let's say like everyone in the market's trying to do this, or I'm going to follow the Lovable approach to kind of like going really explosive big. But do you guys know how old Lovable is as a company? Thank you. It's a 4-year-old company. Lovable did not launch 8 months ago or 9 months ago or something like that, right? So it's a 3 to 4 year kind of company. I actually heard from the market that they launched 3 times, and this is their 3rd attempt at launching, right? But no one remembers what the hell they did for the first 3 years, and I think they've all kind of backdated to, they celebrated their 1st year anniversary in Slush last year, but it's like a 4-year-old company, right? And if you want to truly understand and follow the Lovable approach, you need to understand that what they did was they spent enough time not being very well known in the market. I think they tried, they just didn't get very well known. They built a product that really scales really well, and then they launched. And then when they launched, they scaled really quickly. And And that's how they kind of built themselves this reputation of like, oh, we've got X million ARR only since 8 months from launching. It's like company is three and a half years old. It's not 8 months old, basically. And so that's how they manage that whole notion of like timing and instant kind of managing perception market. It's one of the reasons why HLF we haven't launched yet. It's so that by the time I launch, I'm actually like a 1.5-year-old company.
And personally for you, how you found it, kind of with the stresses, kind of like we were chatting about on going after VC funding, like what your experience is over the last couple of years?
Look, it's emotionally draining as well. Sometimes it's not the time that's the thing. It's just that the constant, especially at Whirli, it's the constant needing to educate people about what I do. I feel like a broken record. And this is why I think one startup is doing AI for fundraising, so you can say the same things over and over again to the same different investors. The thing I'll say is that investors are investors, they're not operators. And so you'll often find that founders have a tension with the investing community of like, investors don't really know that much about operating a business. And so I find it personally very exhausting and painful having to explain some very basic business strategy of like what we're doing as a business and stuff like that. I think, look, resilience is really important in the fundraising side of things. You hear a lot of stories of people getting like 99 no's and then they just had the one yes, and Revolut story about how they nearly went bust and only one fund decided to save them. Can't remember which fund it was. That kind of stuff. So I think it's important to think about how you maintain or build up some good level of resilience. A good kind of peer network in the founding community always helps. You just have people to talk to about this. I'm fortunate to have a lot of personal support from my family, my home, my wife as well. Everything we've always been understanding through all the various risks I've taken through my career. But then it's also managing your own expectations. So I'm gonna lie, like fundraising and actually general business building was a lot harder than I thought when I started my first venture. I always say like no one tells you how much time you spend doing boring people admin, which I did on the weekends. I did bookkeeping. I did everything as a solo founder. No one tells you how exhausting kind of fundraising is going to be. Before I came into this sector, all you hear about is the headlines of TechCrunch, like, oh, look at all these people raising all this money. Surely it can't be that difficult to raise money. And then when you started, it's really, really difficult. So there's a good expectation adjustment for me. We now have this whole thing at ARV where we're very thoughtful about like, look, as we got to maybe do our seed fundraising next 3-6 months, we know this is a short list of 10 to 15 funds we want to hit. We know these are the 2 that we really want to say yes, and these are the 5 we don't mind, or 6 or 7 we don't mind, and then the rest that are a little bit like, meh, I don't really care if they say no. And so then when they say no, you feel less of an emotional kind of, because we're like, oh, we just thought they was going to say no anyway. I didn't like the partner anyway. kind of just a bit of coping mechanism, like I didn't like them anyway. So, or I was always going to turn down their term sheet anyway, so even if it came, it didn't matter. And it's small things, but that does help with the emotional baggage, because I think like, look, people always talk about fundraising from a time perspective. Yes, it's time consuming, but I think the thing that really gets founders, for me personally anyway, is actually the emotional baggage and just managing the emotional side of things. So I spend all my time just thinking about like just prepping my own expectations, managing that, making sure I have a good network community around me. I don't think there's a real good silver bullet or cheat code to fundraising, basically. Apart from some of the tips I shared earlier of like it helps to start on the front foot when you've already got a good reputation in the market, when you've already got good signals going for you, basically.
Perfect. Well, look, we're just about out of time. I think you'll all agree that was massively refreshing in terms of hearing from times that maybe didn't go quite well and what to do differently this time. So I think Nigel deserves a round of applause.